I've been investing for almost 3 decades. I've lived through the dot-com bubble, the great financial crisis in 2008, 2009, and everything in between. This is one of the most volatile stock markets that I've been a part of. The market can literally move off of a single headline. You want to know what's going on with the market? What should I be doing? Should I be buying stocks right now? Should I be panicking? Today is only the second time we've shared chart day. This is typically something we do every single Wednesday in our Patreon Discord, our private community. I want to bring you up to speed on the NASDAQ 100, the S&P 500, and 20 individual stock tickers chosen by community members, including Nvidia, Tesla, AMD, and more. This is the live, unedited, uncut version from this morning. Welcome to a special edition of Chart Day. I'm your host, Eric, Mr. Fired Up Wealth. It's Wednesday, April 9th. Now, this is a special edition chart day for a few reasons, but we're going to post this on YouTube. We're going to cover QQQ, the S&P 500. I'm going to show you a chart, tell you where possibilities are of what could happen. From the extreme to where we could potentially bottom anytime soon, depending on what happens. And of course, tariffs and headlines are going to move markets. We're going to talk about some of that. Some more retaliation here this morning from China. But we're going to cover the QQQ, NASDAQ 100, as well as the S&P 500, and 20 individual stock tickers chosen by community members. Now, we've got an exciting lineup today of stock picks that we're going to go through. For example, Snowflake, Micron, Apple. We've got Mercado Libre, Cloudflare, Intuitive Surgical, Rocket Lab, Shopify, AMD, AppLovin, Nvidia, Tesla, and more. So I'm excited to bring this to you. I'm going to go through each chart and I'm going to give you an idea of where it could go. Of course, technicals are broken. So your traditional Fibonacci's and things, when you look at the pivot points, a lot of those are just really messed up. Some of the prices are back to bear market 2022 prices. So it's really hard to know where a stock might go. But I'm going to give you an idea on a chart. And I'm also going to tell you some fundamentals. If I have any information I could share, maybe about a stock, its concentration to China, some risk to consider if you're going to buy it. Now, I've been telling you guys for months and years, and recently here, October through February, I've been telling you what? Wealth is not created buying tops, FOMO tops, frothy stocks in a bull market. Wealth is created in bear markets. You just don't realize it's the next bull run. Well, guess what? We're in a bear market. Can stocks still go lower? Of course. And that's what we're going to show you today. Look at some possibilities on a chart. Now, before I get into that, I want to show you just something really quick. This is, if you go back to February, pretty much around the top, I shared something with you guys in Eric's watch list. This is Discord. Now, of course, guys, if you're interested in joining our private community, there's a link pinned in the comments. Check it out. Patreon, Fired Up Wealth, Patreon. That's really where the community lives and breathes. That's the heart of the community. We talk every single day in Discord. I'm constantly keeping the community up to date, whereas YouTube, I might only do 1 or 2 videos a week. There's lag time. This information's in real time. When I'm buying a stock, when I'm selling a stock, what to watch out for with the market, where the technicals could go, where we might bottom, areas to look for on charts. And that can be very valuable and pay for itself very quickly, especially in a bear market like this. So definitely check us out. But this was from February 23rd. I've been telling you the market needs a correction. Here are all the reasons that the catalyst, the negative market catalyst from inflation, tariffs. And I was telling you guys back October, November, I was raising cash. I raised about $300,000 cash in the main and said, with Trump, tariffs are going to come. Of course, nobody thought we were going to have a bear market from February to now, just one of the fastest bear markets in history, just elevators straight down. And right now in pre-market, we're testing the highs, both in the NASDAQ and the S&P 500 from 2021. So if you bought the top of 2021, you've made a round trip in 2025 here. But, we were talking about how the S&P's at 23 times forecast. There were already talks of recession before this. And this just dumped gasoline on everything, right? But this is the most expensive rating here since 2001. A lot of people were saying, dot-com bubble, AI bubble, 2.0 kind of a thing from the great bubble that we saw, the tech bubble in 2000. Now, I think AI is still the future. I'm buying AI stocks. Were some of them expensive? Yeah. We talked about air pockets for months. We were saying, hey, don't buy these stocks. Don't buy air pockets. We'll show you a couple charts so you have an idea of what I'm talking about. But we had lots of bearish sentiment. The VIX was at that time 20%, but the VIX now, of course, I'm going to show you a couple different things here today to give you an idea. So here, just let's kick it off, guys. So if you look at what's going on right now, we've got China slapping 84% tariffs on U.S. goods in response to Trump. So this is not going very well. And of course, the market hates uncertainty. Anytime you have uncertainty, stocks go lower. So you've got that issue. Now you can see the futures actually have pared back a little bit. This happened on Monday too. And then, I think the futures were down 5%. And then it was only like something like 2%. And then it flushed out. So it's really hard to say. We're going to look at the chart and talk through some of this. And headlines are going to move the market. This is really tough, for us individual investors, because it's just hard to keep up with what's going on with Trump tariffs and everything. Bonds crater 10-year spikes briefly above 4.5%. This is a pretty big deal, because if you think about what's going on here, you want those rates to go lower. In fact, there's speculation that Trump's doing this on purpose to try to get lower rates so they can refinance debt. But what you're seeing, perhaps even more alarmingly, is U.S. Treasuries are also experiencing an incredible aggressive sell-off as we go to press, adding to the evidence that they're losing their traditional haven status. You're seeing people go to German bonds and so on. And so inflation could be one of the reasons why it would spike instead of go down. But a lot of this is probably money going elsewhere because of just uncertainty with the U.S. and they're not so happy with Trump's tariffs, right? So I'm not going to go into all the whole tariffs. The background. If not, definitely follow the channel. And even on Patreon, I've done some free live streams kind of bring up to speed. I'm sure you know the gist of it by now. If you look at Walmart, basically scrapping their quarterly operating income forecast. And this is the problem. Earnings season is kicking off essentially in a couple of days here. We're going to have big banks on Friday. And you're going to see, even if these companies beat on the top and bottom lines, they're not going to be able to give any guidance. And guidance is going to be most critical, and you're not going to get a lot of it. And so there are a ton of risks here, like, for example, mega cap tech not being able to give guidance, maybe cutting CapEx, which is a threat to the AI trade, and many things here. Things start to break, and it just snowballs, right? So looking at the VIX, you can see this huge spike here, 57. The last time we had anything, was higher than that was the pandemic in 2020. And they have to go all the way back to the great financial crisis, 2008, 2009. A lot of you weren't even investing during the financial crisis. And if you look at some other stats I've been sharing in the Eric's watch list, I've been really busy keeping you guys up to date. But if you look at some of the information I was sharing yesterday, so we've got the worst 4-day losing streak since the financial crisis in 2008, 2009. And if you look at the forward EPS, the S&P, 18x, right? X mega cap tech is 15x. But of course, earnings, this is based on forward EPS, and we don't know what the guidance is going to be. And so if that guidance comes down, now this 18x turns into a 20x and so on. And this is the fear. The market's trying to reprice, and there's just too much going on for the market to be able to keep up. It's insane right now. And I'm not panicking, and you shouldn't either. One thing that I'll say before I get kicked off with the charts, first of all, wealth is created again in bear markets, not chasing FOMO tops and bull runs. And when these stocks in February were at crazy levels, I said, don't buy these stocks. I was raising cash. I didn't buy stocks for 6 months. Now, I will admit that I did buy a little bit early because I was expecting something like a 10% correction in the S&P 500, and we got a full bear market. But I still do have some cash. I'm still buying. I was even buying yesterday. I've been buying pretty much every day now for a couple of weeks. And I intend to continue to buy because I'm thinking about long term. And I know that some of you traders, close your ears for a second. You don't actually lose anything unless you sell. And if you look at the stock market history, I'll just show you another quick chart here or two. Couple things. So first of all, if you look at the resilience of the stock market, so you can see all these things. This goes back to 1936, and you've got recessions and wars and crashes and, Gulf War here. You got Black Monday. You've got the dot-com bubble. You've got more trade wars from Trump's last term. Vietnam War, all these different things. But what's the direction of the stock market? The US stock market over time continues to go up. And every one of these events is just a small blip on the radar. And this will be as well when you zoom out. And you zoom out, you're still up, big over the last 5 years. It's been an incredible run. And this is one thing that you really need to pay attention to. If you don't stay long, you try to time it, especially now. It's too late to try to sell out. And can you reposition? Yeah. Can you sell your lower conviction stocks and buy higher conviction? I think that's fine. But to try to liquidate, if you try to time the market, it's impossible. And if you look at this, if you've invested all days with this $10,000 over 20 years, you have a 548% return. But if you miss the 60 best days, you actually lost 57%. Missing the 10 best days, look at the difference in performance, 197% versus 548%. I do believe you're going to get one of these large pops. You had 11.6% here in 2008, all the way down to a 6.3. You saw yesterday, before we had more tariff news come out, the S&P 500 and the NASDAQ were both over, the whole market was up 4%. And you were on track for one of these 5% type days. Of course, that reverse went the other direction when you got more tariff news and headlines. And that's going to be really the scenario that we're living in. That's the reality we're going to be living in until there is clarity. And unfortunately, that's probably not going to happen anytime soon. It's not going to happen quickly. It's going to take time. It might even take a month or two to have some clarity, but then you have earnings. And could this put you into recession? Of course, that's the risk, and that is the possibility, right? All right, so we're going to start out with SPX. This is the S&P 500 index. Now, if you look at the top here, we're at 6147. So 5,500 was the area that a lot of people were looking at when we had that first wave of selling. Of course, then we had last week, Wednesday, a week from today, you basically had Trump come out and say, hey, we're going to put all these reciprocal tariffs, and they were much higher than anybody anticipated. So people were pricing in, maybe 5,500, maybe 5,000, something like that. At the very worst case scenario, this is probably going to be a correction, not a bear market. A correction, of course, is going to be 10% to 19% on the S&P 500, 20% is a bear market. So if you get a correction in the S&P 500, it's not unusual to have 10 to 15% on average, and have something like the NASDAQ, the Russell 2K, they could be down 20, 25%, just in a correction. So you have a bear market in a couple indexes, but the S&P is not. Well, when we open up here this morning, we're actually pretty close to that 49.75, which is really amazing if you think about it, that we're not down more. And I think that just kind of shows you that the selling is starting to get exhausted. But if you look at this, here's some possibilities of what could happen. So this line is really Monday, kind of where we had a flush out. Is very short-lived. This goes back to basically January 2022. Now, if you look at tech rolled over November of 21, but basically it's the highs from the last bull run in 2021 before we had the bear market in 2022. So this 48.18, we basically kissed that level, and then you can see we bounced up. In fact, yesterday we bounced all the way to here to 5,300 area, and then rolled back down to 49.82 at close. And now we're down a little bit more, but not quite to this 4,800 level yet. That's a key area to watch, 4,800. And if it does break, you're looking at 4,400, and maybe even Jim Cramer thinks 4,000. Now, where we're at, this low we've made so far, this is 21.6% from the highs, not year to date, but from the highs. And here's the problem. If you look at, for example, SPX, so year to date, it's only down 15%, right? But if you look at the actual, we went higher, of course. We had a rally January and February. And so if you use the very top, not the year to date, but the top, this is 21.6%. And that's what you use for a bear market. It's 20% from the high to that lowest point. So we essentially had a short-lived bear market, and we're teetering in that bear market area. Again, this is the S&P 500, the SPX. Now, if we go down to say 4,400, which is possible, especially if you get a bear market, 4,400 is another area to look at. It certainly could bottom before then, 45.91, something like that. But 4,400 is 28.4% off the highs. And Jim Cramer says 4,000, that's 35% from the highs. And that's in the S&P 500, which means the NASDAQ, the Russell 2K, those spec stocks are going to get hit a lot worse. Here's the thing, guys. Stay calm. Don't panic. odds are that the market recovers in a year or less. And if you get some clarity with these tariffs, and if earnings aren't too bad, it could take a quarter or two, but it might not be nearly as bad as a lot of people are thinking. But here are the possibilities. It could get really, really ugly, especially if earnings start missing and things. You're going to have a comfort level. This is scary to some people, maybe at 4,800, but then you're going to get comfortable being down that much. And then you'll be ready to sell for another leg lower, and it just continues and continues. So bear markets don't generally just snap back and V-shape to all-time highs. It happened in 2020, but that was because of stimulus and the pandemic. So far, we're not seeing that. The Fed's not cutting rates. You're not seeing them come back and buy treasuries. If the Fed starts doing something like that, that could be a catalyst for the market. The market needs a catalyst. Right now, we don't have it. You need to have some cash in case prices go lower. I know that's hard, especially if you're a new investor. If you don't understand, how to dollar cost average, how to manage this, the masterclass videos on Patreon are very helpful. Go check those out. It's patreon.com/firedupwealth. But big tech came from 33 times earnings to 22 times earnings. That's the same as 2022 in the bear market. So we're getting there, guys. I mean, certainly can go lower, but we're beat up pretty bad. The Magnificent Seven names basically trading in the bear market of 2022. And we're not in a recession yet. It's just the market's forward looking and thinking that that's coming. So I just want to check in, make sure everything's good before I continue. Looks like everything is. Thanks for letting me know. Love the suit. My glasses are fogged up. I'm so fired up this morning. I'm actually really excited about this. And I was even rarely a little bit nervous just because I want to do a good job for you guys. I know how important this is right now to try to get it right. Unfortunately, nobody knows exactly what's going to happen. I'm just doing my best to help kind of educate you guys and put you in a position to succeed. And that's all you can do. And if you do it the Fired Up Wealth methodology, it's really hard to lose long-term. It's a lot of just psychology and discipline and just keeping your emotions in check. All right. So this is the NASDAQ, the QQQ. See any differences here? We're resetting. So I got rid of all the orange, those previous chart days. Yellow is today's chart day. You can see a mess, and we don't have to worry about Fibonacci S3s and anything else. We broke the trend. We broke the 50, the 100, the 200 day. We're in a free fall. So where could we possibly go? So I just showed you the S&P 500. This is the NASDAQ 100, the QQQ. You can see this is the low that we got to, actually lower than the high in 2021 is where we got to on Monday. If you can believe that. Pre-market, you can see we're up here about 416. But this line right here, if you can see this green candle, that was just very short-lived. It got down here, which takes you back lower than the highs from 2021. If you bought the QQQ at the very, very top, you would have been down on Monday. That's just incredible. Now you can see this is the line right here. That's kind of the top of 2021, and we are slightly above that now. Now, what's interesting is the S3 is 424, so we're pretty close compared to the SPX we just looked at. So if you look at this line here, this is the 408.71, 2021 highs. Give or take, it's somewhere in this range. Intraday might be different, but you get the idea. This is 24.5% down. So if you've got a 20% on the S&P, it's actually surprising that the Qs aren't down even more than 25%. This line here is 25.6%. So we've touched but 26% essentially from the highs in that range, give or take, is what we've hit so far this year. 394 is another area to look for. That's 27.2% from the highs. Again, the highs up here, $540 in the QQQ. 366 is another area, 32% from the highs. If you get into a bear market, if you look at 2022, you got about a 37% drawdown. 35 to 37% in that range, give or take, because we had kind of a washout moment here. The bear market low was 254, and that was 38% approximately from the top. So from going to here was 38%. If we repeat that same scenario, you look at $340. Right now you're at 416. So it gives you an idea of kind of, I think, the worst case scenario. Now, understand this. This was a bear market in 22, but it wasn't a recession. So is it possible that it gets, maybe even worse than that? Yeah. And I'm not trying to scare you. I'm just telling you, I'm trying to give you an idea of what could happen if things get bad. The market wants to go higher. The market wants to have clarity with China tariffs. You can see that we're actually we're not doing that bad right now. I would have thought maybe worse. A lot of it is priced in, but a recession and earnings revisions aren't necessarily priced in yet. And this is where you'd start looking at these 30 to 37% type scenarios. You know, once every generation, you get a 50% drawdown. I don't think we're at that moment yet. And a couple things I want to share with you guys that I think could be really helpful for you is that if you look at let me just find it here, macro channel, right? So this macro channel, so down 15% on the S&P. Now what? You know, if you look at the final year loss, there's 3 green years, 14%, 25%, 16%. This was stimulus driven, the pandemic, 2009. You had a really rough time here. You know, year to date low, 48%, another 25%. This is generational type situation here, you know, 2008, 2009 crisis. And we've seen some volatility. In fact, the semiconductor ETF had the worst 2 or 3 day stretch since 2001, I believe, you know, around that .com bubble area. So the odds aren't looking good when you look at that chart. Now, on the other side of it, to try to give you some positivity, you look at the biggest 4-day percentage decline since 1950. So April 8th, 2025 was ranks number 12. It had 12.1% 4-day drawdown. But look at all these other ones. A year out, up 28%, 69%. You know, 3 years, you're up 55%, 63%. 5 years, 119%, and so on. So long term, you know, if you're buying these prices, you'll probably be happy in a year, 3 years, 5 years. In the short term, of course, I understand, guys, it does feel scary. I've been investing 25 years. I've been through a lot of these, including, you know, I started out right in the 1990s, and I lived through the .com bubble and that Great Recession, the financial crisis in 2008, 2009, and it's not fun. But both times I bought. Now, back in the .com bubble, I didn't have a lot of money, but a lot of my wealth comes from buying that 2008, 2009 crash when no one else wanted to, and there's blood in the streets. This is not a panic. I mean, we had some capitulation Monday, but this isn't mass chaos panic like you saw in 2008, 2009. Over a couple day period, you saw some areas of that. But if you look at the numbers, it was absolutely brutal. So we're not in that situation. Overall, the economy's not doing really that bad. So I'm going to switch gears here. We're going to share some individual tickers chosen by community members. And we've got 20 of them to go through. So let me start with that. I just need to find the list here. Okay, so the first one that we're going to talk about today, and like I said, we're going to cover a bunch of tickers here. I'm going to go through and give you any thoughts that I have. I'm going to be very candid. This is real talk, raw, unedited, uncut, just me talking to you guys, trying to help you out. These are some possibilities to watch, right? So Micron is the first one. So I liked it $85 or less. Of course, that was before, you know, we had these Trump tariffs that were a lot worse than anticipated. Now you got to understand Micron is going to have exposure, of course, to China. All these semiconductor names are going to have some exposure to China, some more than others. If I look at Micron, just want to double check here. So here's a couple of things for you. So Marvel, 42 to 43% of Marvel comes from China. Broadcom, 32 to 35%. In the community portfolio here, I shared some other ones. TSM, 16%. You know, Micron is somewhere in that range as well. But all these semiconductor companies have exposure to China, and that's a risk with these tariffs, especially when we're throwing 100%, 80% type tariffs. So it's not as high as many others. It's 20% for Micron, right? But memory is very cyclical. So there's really two sides of this business. There's the traditional memory, which is going to be more of a commodity. It's cyclical. The other side of the business is data center, and they do have some competitive advantages in some of their products. In data center, they had 300% growth in the last quarter. So one side of the business kind of struggling, one is crushing it. If you could just buy the data center portion, of course, you'd be on fire. Now AI, and if you think of AI edge, you think of the future of AI when you're thinking of, you know, NPUs and processing on the device and things like that, you're going to need a lot of memory. So I do think that Micron, even though it is typically more cyclical, I think there's a big future with data center and also just consumer electronics and memory. Of course, there are a lot of manufacturers that make memory, And so it's a very competitive space. It's not like Nvidia where they've got this moat and this hardcore competitive advantage with CUDA. It's not like that, right? So you're not going to pay as much of a premium for something like that because it's just different. Profitability, 34% profit margin, where as Nvidia, of course, you guys know, is in the 70s, right? 74%. I think it's closer to 70% now. But I do like Micron. It is getting attractive. I bought some recently, I think it's 61 or something in that area. Got really lucky on one of those snags within a few cents. Sometimes you get lucky and who knows, it probably goes lower. But the growth on this, Seeking Alpha here is showing 42% revenue growth. Valuation, again, you're not going to pay as much of a premium, but the forward gap PE is 10. Of course, this is a forward, and that PE number, it can go higher if the EPS comes in lower or guides down, et cetera. So what's the impact of tariffs? If there's a recession, what's the impact of that? And now that 10 is not a 10 anymore. And now it might be something like 15, and that might be closer to average. You have to look at historical metrics. But, price to sales, 2.07. It does pay you a very small dividend, 0.7%. So kind of a DJF type player. Over the past 5 years, it's only up 35%. So it has not done that well. I think it's important to point that out. This is not like one that's crushing it, like an Nvidia or Broadcom, something like that. And so what I recommend, guys, this does pay that dividend, but the growth's not there. You need to focus fire on a couple of stocks that fit your blueprint. And this can be really hard because you're kind of shotgun praying like, oh my God, everything's on sale Monday. And you kind of don't have a plan and you panic and you miss a lot of it, right? You want to have limit orders at specific prices, and you want to focus fire on a handful of stocks. Depending on your portfolio, how much cash you have, maybe 2 stocks, maybe 5 stocks, but don't try to buy 10 different stocks. It's going to be really hard. You're going to run out of cash faster. It's just very hard to manage it. Trust me, I know, because I have 3 portfolios and I'm trying to manage way more positions than I should be. And that is creating some challenges because of, if you're starting new positions, in the main, I started something like 6 new positions. Well, if you've got at the time $2.5 million portfolio, you need 25 grand for just a 1% position. So even with $300,000 cash that I came into the year with, it goes pretty quick, right? So I do have some cash left, but I've dwindled down a lot of that. I've spent, a lot of it, and I've added some cash back into these different portfolios. I've probably invested something close to $400,000 so far this year, and I've got maybe another $100,000 in cash that I could deploy lower. So that's kind of where I'm at. But Micron, if you look at this, what if CapEx is cut to macro? That's going to impact all these AI related names. With that said, Micron, the low is $48. This goes back to 2022 bear market. We had a double bottom around 48. I mean, literally almost to the cent, 48.45 and 48.43. And then of course, what happened from there, a grind up 45, and then this huge parabolic run. So you look at this, $48 to 157, way overextended. I said this in a previous chart day. Anything you see in orange is a previous chart day. It's not where I like to buy. This is FOMO chasing. We call it FOMO Chasers Pizza LLC. FOMO Chasers Club. We call these air pockets. You don't want to chase air pockets. If you take a trend line, you don't want to buy, especially above the, way above the trend line like this. But you got to be mindful of the 200-day moving average. Those trend lines, there's other oscillators you can use. We teach these in the master class. And generally, we're looking at charts here from a long-term investing perspective. So 99% is going to be fundamentals, and the last 1% is a chart. But this is going to tell you, even if the fundamentals are strong, you're going to come in here and say, okay, well, this is a FOMO chaser club. I'm not going to buy this at 157 or even at 135 because I'm way above this trend and it's not sustainable. That stocks always come back to some sort of mean, and that these trend lines work like magic. Algorithms love pushing things. And a lot of it's self-fulfilling prophecy with technicals, but that's just the way it is. More electronic trading. You can see it's broken. This whole air pocket's completely busted. And now recently it got down to basically the middle of the 2022 bear market. So it looks like I bought some SHD for $23.91 in the dividend portfolio. I've got a bunch of limit orders in, and I'll let you know as they kind of clear. 3 different portfolios, of course. So, could it go back to $48 if we go into a bear market? It's possible, but also remember here that we've got 2.5 years of growth and improvements in R&D. So I start looking at some of these. It's like, man, it's got to have decent support in that 48.50 level. is it really going to get that low? It got to 61. I mean, that's getting down there. So is it a buy at 65? I think if you don't own a position, I mean, yeah, because what's the risk reward here? I always say, what's the risk reward if you buy at 157? Well, the risk is all the way down here at 75. The reward, there's probably at R3 at some point, maybe that was 170 or something, but very limited upside and a lot of downside. At this, there is some downside, but let's just, humor me for a moment and say, hey, we got support around 48 for $50. This is the area that you have to focus fire in. And of course, we're above it now. So let's just delete that. Let's just pretend you wanted to buy it right now. This is the area to focus fire, even if it went lower. This is 41, which is highly unlikely. You have a range here basically of 65 to 41. So you buy some here, it goes lower, you buy. That can be really hard, especially mentally. If you haven't been doing it for a while, it's really hard to say, I'm going to buy this range and I'm going to focus fire in it. And I might put, in a bull market, you might only buy 3 or 4 lots. In a bear market, you might have 10 to 20 lots. So you have to aggressively buy, and you might buy a couple of shares here and then, 4 shares lower. And then the risk of that, of course, if it never gets back down to this price, you're going to kick yourself for not buying here. So this can be really hard. It's a mental game. But I think if you say you buy some here and it doesn't come back lower, it's a high quality problem. You made money. If it comes lower, you have some room to add. So let's just say you wanted a 2% position. Maybe you do buy, a fourth of it today, right? But then if it starts free falling, that's where you have to be really tactical, with your DCA targets. But I don't think it's going to get below $50. So the range really is $50 to $65 is probably the worst case scenario on Micron. Could it go lower? Yeah. I mean, there's something we don't know about, but I think it's helpful to look at the chart and say, this is getting pretty washed out here. I mean, you're erasing 3 years worth of gains on a company, but you have to do what's best for you, and it can always go lower. Snowflake, same kind of deal here. I like this stock. It's my second largest holding in my main. It's probably the third or fourth largest holding at this point in the community portfolio. This is consumption based, not SaaS. Now, if you look at this, it got down to like $120 on Monday. Now it's 135. It's really hard. It's really hard to time these bottoms, and it's hard to know, like, is this going to be kind of a dead cat bounce and then lower later? Well, just in August of last year, we saw $107. So is it possible that if things get really ugly, you can see a 107 again? Back here in 2022, you saw $111, $110 price. This is the bear market. And just last summer, we actually broke through that. This is when Slootman, said he was going to leave the company, new CEO. The sentiment was terrible and it was way overdone. So it didn't get to 107, but 120, I think, is still probably overdone. But with that said, this is not a profitable company, and in a bear market, it's going to get punished. So could it go lower? Absolutely. If you don't own it, if you're buying it again, 135, you probably have $100 floor. So if I were to draw a circle again, you're at 135 to basically $100 is right there. This is your focus fire. This is much easier, and the risk reward is much greater than if you're buying the stock, when it was $237. This is just in February of 2024, or in the pandemic when it was $400, $429, right? So even recently 166. I mean, if you're buying this stock at 135, can it go lower? Sure. But you probably have a pretty solid floor at 107 or even $100 if it breaks through that. In the bear market, it got to 110, right? So I look at this and say, hey, this is a lot easier now to DCA. The problem is a lot of you guys might already own the stock and you're wondering, where should I add shares? You should add shares to the stocks that you have the highest conviction in. And Snowflake might not be the highest quality name for a lot of you. I tell most of you to avoid it and to avoid cloud and SaaS in general. Those higher quality names are going to rebound first. Can you make a lot of money on these high flyers? You get back into a bull market and it goes to 250. Of course, it's about risk reward and what you want to buy. If I were recommending, I can't give you financial advice, but if I were recommending, hey, which stocks should you buy? Depending on your risk tolerance, this might not be the first choice, right? But keep in mind that, consumption based, if you go into a recession, it is economically sensitive versus recurring revenue SaaS, or maybe like a cybersecurity name, which is considered more defensive. I do think this is a phase 2 AI beneficiary long term. And I'm definitely a buyer myself. I would add more shares myself if it gets back to under 120. And I missed it Monday. Coulda, shoulda, woulda. I didn't think it was going to go quite that low, that fast. And maybe we don't see those prices again. But if it does come back below 120, hear me say that even though it's my second largest holding and it's overweight, I would buy more shares myself. Snowflake. Next one is ACLS. Now, this is a small cap, and be careful with these because this is going to be more of a spec type play, even though it is, the last time I checked, profitable. These are not going to recover nearly as fast for a lot of reasons, but 4 P ratio 18.72. Here's the thing. First of all, it's got China exposure. So this is a fired up winner. We bought it in the 20s, back in, 2021. We trimmed it. We didn't time the top perfectly in the trim, but like 160, 170, and it went all the way to 200. Like, I should have waited 200. Just crazy. It was like a 10x type of run in 18 months. I have 200 house shares. So this is where, we talk a lot about playing to win and house shares. And if you have a stock that rips 500% or 1,000%, like the Rocket Labs and the Palantirs that we were buying, we're buying Rocket Lab $3, $4, Palantir $9, $10. When you have these big runs up like that, you take some profits, you take out your cost basis and maybe even some additional profit, you keep the rest as house shares, you can't lose. And when I was doing that just in February, people were questioning me like, aren't you a long-term investor? Why are you selling Palantir? You don't think it's worth $100 a share? I'm like, I don't really think $100 a share is a great price for Palantir if I just bought it 18 months ago for, whatever it was, 10, 15. And we've had it since 2020 when it was a direct listing. That's when we first started buying as a Discord community. But you get the drift. It makes more sense now when you say, why are you trimming these stocks? Aren't you bullish on them long term? Now, the thing about it is that if you look at the best performing portfolios are people that are dead. So the truth is, honestly, if you have a winner like that, winners keep winning. If you zoom out 5-10 years, if it does what you think it's going to do, it probably will be higher. And you say, well, I didn't need to trim it back then. But in these kind of moments, now I have the ability to have cash. It helps a lot with the psychology, and it allows me to position that cash at lower prices again, and it will help with outperformance. So if you look at ACLS, right? It was 46 in the 2022 bear. You see this, 46. We're actually lower than the 2022 bear market. So I think it's important to point that out. In the S3, we actually have a Fibonacci S3. This is at 38.73. So could it break 40? I think there's a decent chance that it can, especially if you go into recession. But understand that this is lower than the bear market. But again, this bear market wasn't a recession. If you have a bear market with a recession, it's going to be worse. So it could easily go $35 or even less than that. I think that the China and tariff regulations are a big risk. So the stock's down. There are other reasons. Automotive is a big part of their business. And automotive, of course, has been hit really hard. If you look at the exposure, right? So I have 200 house shares, profit loss. My profit loss is $28 cost basis, but it's house shares. So it doesn't really matter so much the cost basis. But so 77% Asia exposure, 40% of that is China. So 40% of its business is Chinese. Think about the risks. And it's a small cap. So what is this? It's a $1.37 billion market cap. A lot of these small companies are going to struggle, even the profitable ones in this type of situation, especially if it has 40% China exposure. I mean, China could literally say that we're not buying anything from the US anymore. That would be 40% of their business. How much is that? How much of it's priced in? I don't know. And they won't even be able to tell you probably guidance to give you an idea. So there's just way too much uncertainty. The stock's just going to keep selling. And if you have cash right now, most people aren't focusing on ACLS. There are a lot of other higher quality names that people are going to deploy cash in, right? So it makes sense that it just keeps going lower. You saw this in 2022 with a lot of these small caps. They just keep grinding lower and lower. So it is a 19.4 gap PE ratio, assuming no guide down or tariff impact. But if you lose 40% of your revenue to China, well, now it's not a 19.4 gap PE ratio anymore. It does have 44% gross profit margins, but that's going to be probably lower, right? Because you're going to have to absorb some of those tariffs, which companies do and the consumer does. How much is priced in? Easily could see 30s. You could even see 20s to this stock. You could also see this be the bottom and you could make 100% on it. but it's going to just depend on things that I don't have the answers to and nobody does right now. Upside long term, if things work out, this will be a big winner. You know, you'll make a lot of money, but it's high risk, high reward. Next one's Apple. Apple has had one of its worst runs ever. The stock fell from $260 to under 170, it looks like. So, you know, people were asking me about this and it was 225. I said, I wouldn't even pay over 225. Well, that was before we had all these tariff wars. Of course, that's going to price at a new price. And now that 225 is, you know, 175. If you look at this year, this is from April of 2024, though. And a lot of people have short memories. Apple was just $164 in April of 2024. I think if you put that on a multiple choice quiz, that a lot of people would get this wrong. But it double bottomed here the fall of 2023 and the end of spring of 2024 at 164 area and ripped all the way to 260. So does it make sense that it's a little bit higher here, given that, you know, the company's made improvements? And yes, but if we go into recession, if, you know, something bad happens with China, if iPhone prices, you know, surge 50%, 100%, I mean, just wild things that could happen, this could easily go below 165. But I think that's an area to look at. You know, where it's at here, I think it's probably a good buy in the 160s, but can it go lower? Yeah. And, you know, and it got down to 124 in the bear market of 2022. But remember, that bear market was not a recession. So those are some areas to look at: 165, 125, and, you know, where it recently bottomed 169. So, you know, again, if you're a buyer, you kind of have to, you know, focus fire a certain area. And it's tricky because right now it looks like the market's going green. You know, at a certain point, things get oversold and there's a dead cat bounce. We saw yesterday, people wanted to buy stocks. You had some news that reversed. It's very, very unlikely that this sticks unless you get some sort of catalyst like, you know, China and the US negotiating tariffs. But without it, you know, now China just retaliated. What happens if Trump comes out this afternoon or tomorrow or next week and says, well, we're going to double them again? Well, the market's going to react and now you're going to make new lows. And it's really frustrating because we don't know. We don't know what's going to happen. We don't know what Trump's going to do. We don't know what China is going to do. And that's really the elephant in the room right now is China and the US. I think the rest of these countries, for the most part, can work things out. But maybe 175 is the new floor, I said. And it's, you know, obviously it went lower than that. It went to 169 or 170. But it depends on China impact. Clarity could make Apple and many other stocks fly. You get some clarity with China, this thing's going to go up to $200 pretty quickly, I think. Next one's VST. So now you're talking about some of these AI data center type players. You know, it looks like it's green here at 104. It got down to $89 though. So this is really hard because as an investor, you're like, oh, I missed it. And then like yesterday, you saw people chase yesterday, a couple people, not a lot of people, but a couple people I saw buying, and I'm thinking, oh man, I'm telling you in the watch list, like, hey, you know, you're probably going to have any kind of reaction. And then by the end of the day, you could have bought a lot of those stocks, you know, 5-10% lower. And it's okay. You're not going to perfectly time it. And I've, of course, bought stocks higher as they came down. But this is tough because now you chase it at 104 and then more news comes out next week and you got a new low and you're like kicking yourself. You're not going to be perfect. At the end of the day, you're going to have a mess. When you get through this, your portfolio is going to have, you know, if you're long-term investing, you're trying to buy and you're not trying to be a trader and wait for confirmation and things like that. Even if you're a trader waiting for confirmation, the time that is so damn hard to do. And for me, I look at it as if I think the company is worth a certain price, I'm going to buy it. If it goes lower, it's just a better price. Now, of course, you don't have unlimited funds, but this is why it's really important to focus fire your highest conviction names. This is a rare chart where it actually held the trend line, which is amazing to me. And it actually has an S3 even lower than the stock went. So is it possible that it gets down to 85? It is, but it looks like the market, you know, wants this to be kind of a leader and it's 104. So it's showing some strength here, to be honest with you guys. But this is why I buy the way I buy, because there's no way to know, like, are we going to come lower? And people come on here and they'll say, oh, this is really helpful. You're telling me a stock can go up or down. Yeah. And if anybody tells you otherwise, they're full of shit. They're full of crap. Because nobody, especially with this uncertainty, how can anybody predict that this is, you know, the lowest you're ever going to see on the stock? If you go into a bear market, you have more trade escalations. The question is, are you happy paying $100 a share? If you are, you buy some shares. That's it. Knowing it can go lower. That's the mindset you have to have. And in the end, you're going to have some stocks that are down, maybe 10% if you dollar cost average, right? But then you zoom the lens out, in a couple of years, it goes back to all-time highs, maybe even sooner than that. And now you're up 100%, right? But look at I think it's important to look at this. So this was range bound for years at $15 to $30. So you look at this. This is Vistra. This was range bound. Of course, this is an energy player, so it kind of makes sense that it's holding up. So when I say AI play, it's because you're going to need energy for data centers. It's not like it's a data center infrastructure play. It's energy. But this stock just sat here and did nothing. $15 to $30. I mean, we're going back here 2018. It just sat there flat. Look at that straight line, and then just ripped. Boom, from like $30 to $200. So this is, again, air pocket. You don't buy these air pockets. Here's the trend line. Came down, kissed the trend line. But this is not a crazy expensive stock. It's not impacted necessarily by tariffs. Could it be impacted some by data center demand, things like that? Sure. But you're looking at relatively attractive price, 0.84% dividend. So you could argue that, when it got down here to, what did it get down to? $90, $92. It was probably a little bit overdone. And I actually bought some under $100, and I didn't fill the position. If it goes lower, I'll probably buy more. If not, I let it run, and later I can trim it. So let's just look really quick at this VST. I do own VST and CEG. I have more CEG than VST, although I'm not sure if that's the right move or not. Time will tell. PE ratios and things like that. This is one where they're able to do their own bidding, and so there's pricing power with this company, and it can do well. I mean, nuclear powerhouse in the AI era, time to buy. Opportunities knocking. You can see very bullish comments here on Seeking Alpha. The quant is sell, but analysts in both Wall Street and Seeking Alpha are very bullish. So VST is probably not a bad target because it's profitable. It's not highly impacted by tariffs. It pays a small dividend. Those are the type of stocks you generally want to look for, those higher quality names in an environment like this. Plus, it helps you diversify a little bit if you're all just semiconductors and software and tech. Excuse me. Okay, ELF. So FOMO Chasers Club up here at 219. We were telling you, don't chase this air pocket. It's way overvalued. Even in Discord, we were saying this is going to be a glorious decline because there's no way the stock's going to be worth $200 longer term. It's going to collapse. Had this kind of big run after COVID, like everybody needs ELF Beauty, and then just fell off a cliff. There's other reasons, as you guys probably know, but glorious FOMO Chaser case study. This will go down in history. We told you what happened. Circles drawn up before the drop, so it wasn't up here necessarily, but before the big drop, we drew this second circle saying, hey, it could always go lower. Here's where it's trying to find some buyers now, but if something bad happens, it can go lower. And there's even another leg lower here, but you saw it get down under $50 a share. Now it's back above 50 at 53. We are back to, 2023 type prices here, end of 2022, I guess, prices. So December 2022 area. So it erased that whole, from coming out of the bear market, it erased the entire bull run, and we're back to start. So if you bought this, January 2023, basically you're same price today. So if you look at it, it ripped from 50 to 220 back to 50 round trip. Recession impacts, can it go lower? How much is priced in? It does have 12.82% short interest. So I think that's important to understand that, it could have a short squeeze and pop higher, or that short interest can make the stock go much, much lower. $2.8 billion market cap. I think it is getting interesting at some point. This is not one I follow. Of course, ELF Beauty is not something that I know a lot about myself. You can probably tell I'm not wearing makeup or anything. My wife generally doesn't wear a lot of beauty products either. So we're pretty simple people like that. But, growth wise, it's hard to say if these numbers are accurate, because, you could look at this and say, 35% growth. Well, if you go into a recession, it's not going to be 35% growth, but it does run pretty decent profit margins. And that, again, these can be impacted by tariffs and recessions and things like too. Valuation forward PE gap 26. But again, revised down? Does that turn to a 30? It's hard to say. The price to sales TTM is 2, forward is a 2. I think under $50 is certainly getting interesting. It's not one that I'm personally buying myself, but it's good to diversify. Be aware of that 12.82% short interest, because that can make the stock do some crazy things still. CCJ. I don't know this stock. It's Cameco Corporation. You can see it drop from 62 to. What's interesting about this stock, this is September 2024, July 2024, September 2023. It comes back here 4 different times to 35, and it did it again. So it really wants to hold this $35 level, but this stock has been a dog really since summer of 2023. It looks like it's been kind of in the same range. Well, obviously it popped up and came back to the same range is what I mean. So I don't know this. Fundamentals are 99%. Technicals the last 1%. It bounced just below the fib S3. It just barely broke that and went higher. I don't know. Retest from last summer around 35. It's got a 45.4 PE ratio. Is that warranted? Obviously, 99% of the puzzle is going to be fundamentals. The last 1% is technicals. Mercado Libre, a clear winner since $600. This was a $600 stock in the bear market of 22. And I need to reset this. I hate when it does that. Give me 1 second. The joys of being live. You got to be careful what button you hit. So this thing just ripped though from $600 pretty much on the nose, $600.68 all the way up to $23.74. I just actually added some like $17.50, $17.75. I think I added one in one portfolio is like $17.50, one was like $17.77. But this has been a clear winner. It rallied to $23.74. It's still above the blue trend, as you can see, but it doesn't have as much impact from tariffs. Of course, if the whole, global economy goes into recession, can Latin America be impacted? Sure. But as of right now, this isn't really involved with the trade tariffs. In fact, if you look at it, I posted this in the community port. This is again why Discord is so helpful, guys. If you're not in Discord, you just have access to so much information that you're not going to get really anywhere else. So unlike Amazon or Shopify merchants relying on Chinese goods, Mercado Libre sellers source locally or regionally, like Brazilian manufacturers or Argentina. Post on X from early April 2025 note that MELI doesn't source goods from the US or China, reducing direct tariff exposure. Economic slowdowns in Latin America and hyperinflation and things like that are a bigger risk than the trade tensions between the US and China. Now, what's interesting about Mercado Libre is I've been in the stock for a while, but I've always not had a huge concentration because I don't know Latin America as well. I mean, I generally invest in the US, and there is a lot of macro and currency risk and inflation risk, but the company just keeps crushing it quarter after quarter. And if you look at this stock is under $100 billion market cap. So $93 billion market cap. And the TAM on this is amazing. Trillions of dollars of TAM. Could this be a $1 trillion market cap in the next decade? A 10x or more? I think the answer is yes. And it's one that I always come back to when I look at what are companies that have the biggest TAMs. Tesla is going to be on that list. Shopify, Mercado Libre, these are, Amazon, those e-commerce players, especially when you think about this for a second, Mercado Libre. So they're focused in Latin America, South America. As we have things like satellite, low orbit satellite, right? So that's going to open up the internet like never before. So Starlink, I was trying to think of the words Starlink. I kept thinking of SpaceX. Starlink from Elon Musk. Starlink and Amazon eventually is going to have Kuiper, and you're going to have several other vendors, I think. The internet's going to be open and at the fingertips of more and more people than ever before. The global population's growing, but the infrastructure is growing. Places, countries like continents like Africa, all regions of Africa that don't have a lot of infrastructure with internet connectivity and things. It's going to really open the doors. And I think of Latin America specifically. E-commerce, of course, is a big part of it. But you think of, like, for example, in the Andes Mountains, you think of like Peru. It's really hard to build fiber optic type infrastructure to build out any sort of high-speed broadband internet. But now with something like Starlink, it solves the problem immediately. And the big TAM opportunity, not, just like Amazon, of course the e-commerce is how the company kind of gets started, but most of you probably own Amazon for AWS and for advertising. What's interesting about Mercado Libre is it runs on AWS. So people will say it's the Amazon of Latin America. Two things on that. Number one, it doesn't have cloud services. In fact, it runs on Amazon cloud services, and that's a big cash cow for Amazon, right? But you think about the biggest opportunity for Mercado Libre, I think it's going to be that fintech side. And there are so many people that are underbanked or unbanked in Latin America. And by having more exposure to high-speed internet and cell phone capacity, and just make cell phones get cheaper every year, everything's easier, more accessible. The internet's more accessible than ever before. It's going to open the doors to millions and millions of more people and expand that TAM even more. So can Mercado Libre be $1 trillion market cap someday? I think so. And I think that there's a lot of upside. If you're investing in international stock, this is the stock, in my opinion, that I would look to before anything else. So I'm big on this one. It does have certainly risks. It's not dirt cheap, but I do like this one. If this thing comes lower, I have a bunch of limit orders in this, the 1750 range again today, 1650. Basically, I put an order in every $50 going all the way down. So, and it goes from one share to 2 shares to 4 shares. It just keeps going lower. Right now, the market's going green. What's going to come later? Who knows? Now, here's the thing, guys. If the market wants to just pop from here, it's a high quality problem because I've been buying the whole time. So I'm not mad. I've got lots of money in the market. And if it wants to go bull mode, great. Now, on the flip side of that, you want to have some protection. You don't want to just throw all your cash into it, because if you do have that downside, you want to take opportunity to help that cost basis and just get the best prices you can. It's going to help you, down the road. Your financial future is going to thank you because you're going to have that much more money. Okay. Next one is ET, phone home. ET, Energy Transfer. I'm going to be really quick with this. It's an income stock, pays an 8.19% dividend. You buy it for yield in retirement or for diversification. But in terms of looking at a chart, it broke the S3. It got down to 1459. Everything was broken. If you're buying it, it's not something you're generally buying for growth. You're just buying it for that diversification or that income, that passive income. And it will fluctuate with the energy sector. Of course, oil is at a 4-year low on Monday, so it makes sense that you saw your lows under $15 and it's slightly higher now. All right. If you have a recession, obviously energy is going to be impacted, and stocks like that could go lower, just like everything. Cloudflare, I wouldn't chase it personally at 116. This is back February 2024. If you waited, you could have bought it here last summer for 65, right? And when it was up here, I told you guys again, do not chase air pockets. This is a pretty easy one. You just look at, just draw a quick trend line, and you can see it's not a perfect trend line, but you get the idea. What the hell is this? Why would you buy that? You don't buy that. This is how you lose money. So the air pocket's not even all the way out of this. And I would argue that it's holding up pretty well at $98. It never should have been 177. This is probably a $75 to $85 stock. And it's about $100. And maybe I'm wrong, but the thing about this, guys, is this has been a Fired Up Wealth Discord favorite. We started Discord Patreon back in July of 2020. This was one of the first stocks we bought at 30s. We were recently trimming here 150 to 175. A lot of us. It's holding up better than most. And, a lot of people view this as cybersecurity, more defensive. The S3 is 79.59. So it didn't break through the S3 like everything else. And that's why I say, for me, I'd probably be looking at something like 75.85. But, this is trying to be a market leader and people are wanting to buy it. It's one that's, higher on people's shopping lists. And I think, again, the fact that it is cybersecurity related is part of the reason why it's going to hold up. It doesn't have tariff impacts, and cybersecurity is going to be a more defensive portion of software. Garmin, LOL, chart will not explain. Fundamentals 99%. This is overbought. FOMO Chasers LLC t-shirt on the way if you buy at 246. Even now, it's holding up pretty well. This is a 50% retracement here. From here, you take this number plus this number divided by 2, you got a 50% retracement. I would argue it's still elevated. It could go lower, but it's holding up here around 169, $170. But this is why they call us dumb money, because we buy stocks that are, that go from $76 to $246 and try to justify that. And it's, even if the fundamentals are rock solid, we're going to look at Nvidia here in a minute. The fundamentals are definitely part of it, but when a market has a sell-off, and the stock market in general likes to go back to a mean. So Garmin, this is not one I follow closely. It's got decent profitability. A growth is a C minus valuation. 21. And does it pay a dividend? Pays you a 2.07% dividend. So I do like that. Any kind of growth in the dividend, 1 year, payout ratio 40%. Kind of interesting, but it's hard, right? You look at some of these stocks, you're like, do I want to pay 173 for that? And there's all these other names I could buy. I don't know. It's up to you. It's up to your blueprint, your portfolio. Obviously, if you buy it at 173, it's a lot better than 246. Intuitive Surgical. This is why you have to be patient, not chase these air pockets. Now, this is another one that's going to be in high demand. Doesn't really have a lot of Chinese exposure, from my understanding. $609 up here. But if you go back to the bear market, 2022, $180 stock. There's a lot of things that you'd probably do different if you go back 2022, the stocks you would buy and hold and whatnot. But earnings are in 2 weeks. So this stock could easily, it doesn't have guidance or it misses. It could easily come back. This S3 is 407, trend line something like 360. I think if it got around that $400 level, that's where it starts to get attractive. Of course, it bottomed out like 425 because, again, this is going to be high on shopping list, I think, until there's a reason not to have it high on the shopping list. And that earnings, in 2 weeks could be that reason that makes the stock go lower, or it could be a catalyst, makes it go higher. They could say that we're not impacted by tariffs and that we're crushing it and that we can give you guidance and the stock could go higher. It was just a $609 stock. It is a 67.4 P ratio, assuming no earnings revision. So it's not cheap. It generally does carry a premium. For me, I would probably want the stock under $400 before it'd be obvious for me that I would need to dollar cost average into it, which probably won't happen. That's just the number I'd look at. Rocket Lab, fired up wealth favorite, $3 to $4. We were really looking at the price to sales ratio on this and what I'm willing to pay for it based on the fundamentals. And that proved to be a great strategy because I was able to buy, I think cost basis is under $4. And I've got it in both the main portfolio and the community portfolio. Was trimming it, didn't time 33 perfectly, but I remember trimming some 25 plus, I think closer to 30. It did pop off this 200-day moving average. So this is another one that the market definitely wants to invest in this company. And there are a lot of exciting developments around Rocket Lab. Is it worth $18 a share? I mean, it behaves like a market leader. It's a good spec stock. I don't think you would buy it as anything other than spec, in my opinion. The growth in this is really solid. I mean, with the revenue growth, assuming it stays, profitability, of course, it's a company that's growing. It's young. You're talking about a $7 billion market cap, but I think when we were buying it, it was, like a $1 billion market cap kind of a thing. So if you look at the valuation on it, it's not going to have, PE ratio at this point, but I want to look at the price of sales, 13. It's pretty expensive, right? So it's holding up pretty well considering it came from $4. Obviously it dropped from 33 to 18, but if you look at where it came from, it's still up, 400% or 500% since last summer, which is pretty incredible if you think about that, especially considering a lot of the other names that we look at today. So it's holding up very, very well. BN. How's everybody doing? Hopefully this is helpful. I mean, obviously right now you're seeing buying, but it's good to at least have an idea of where things could go. This is, if you look at these previous chart days, what's the risk reward here? You're looking at this. It's so hard to chase these. It went from 28 to 60, a double on a boring name. Brookfield Corporation's a Canadian multinational company, blah, blah, blah. It's probably impacted by tariffs, I would imagine. And it dropped here. It didn't quite get to the S3 at 43. But this is just a bad buy. I mean, it's just a bad buy. It's so elevated. Even now, you don't buy these FOMO rips like this. You just can't, right? So the financials look goofy on Seeking Alpha. I took a look at it. Make sure you do your DD. Fundamentals 99%, technicals 1%. I'm going to kind of move on past this one because I don't think there's a ton of people that are maybe interested in that one. No offense. Doesn't mean you shouldn't buy it. Especially considering YouTube. I know on YouTube, people want to talk about Shopify, not Brookfield. So Shopify, I like this in the low 70s. I picked some up at 71 in the community portfolio. Pretty close to the bottom, actually, within $1 or so. And that was a new position. I was hoping it was going to go lower again this morning to buy more, but is it attractive at 77? Sure. But considering, some of these stocks are still hovering around the S3s, there's definitely downside. This trend line here is 58. And in the recession, or not the recession, but the bear market of 22 is a $25 stock. Most recently, we were focus fired 65 or less last summer. And of course, it dropped to 48 briefly and then ripped from 48 to 129. A lot of people were accumulating down here, and you're kind of back in those levels. So, you're a little bit higher, but understand that Shopify is impacted not only from the Canadian tariffs of the US, but also Chinese tariffs. It's certainly not immune. All right. Shopify. Now we're starting to get some juicy ones. AMD. This is a stock we bought pretty much at the levels it's at. When it was $200, I said, I'm trimming some of this. I think I sold some at 190. Of course, it went to 227. I was kicking myself, but now I'm not at all. And that's the thing. You're never going to perfectly time the top. You're never going to perfectly time the bottom. This is a stock when it was like $100. I was thinking, hey, man, if this gets much lower, it's getting pretty attractive. It got all the way down here, guys. I was buying some yesterday at 77, capped out around 75, 86 or something. It was pretty much right under $76. Can it go lower? Sure. Again, last bear market, $54 stock. But if, we're talking about going back in time 2.5 years, think of all the improvements that this company's made since this point. Can it go lower? Yes. And bears are listening to this right now. Oh, it's going to go under 50. It could, but am I okay? Do I feel comfortable buying 75, 80 bucks on AMD? Considering what I know about the company and the future of the company, AMD does have risk in China because with the CPUs, there's a lot of, PCs, laptops that are going to have AMD chips. It does have risk, right? It does. I look at AMD as the CPU leader for data center. And I think with inference, you're going to have more demand for CPUs for data center and for inference. And AMD is going to be the leader. It's hard for AMD to catch up with Nvidia. Nvidia dominates, has that differentiation really with that soup to nuts solution platform that includes, the CUDA software. That's where AMD really struggles. Will it still sell some GPUs? Yeah. Will it still do well in data center? Yeah. And I think it's the best of breed company if you're buying CPU for data center. Micron, best of breed for memory for data center. GPUs, best of breed for data center. It's going to be Nvidia. I want to remind you guys that we are still in an industrial revolution 4.0, and AI is still a thing. It's not going anywhere. And these companies are going to be worth more later. Do you think that Nvidia and AMD and Broadcom and Marvel and all these different names are just dead? No. Could they go through some volatility? Could we have a bear market and they could go lower because CapEx could be cut from some mega cap tech names? Absolutely. How much is priced in at this point? Quite a bit. Can they go lower? Sure. But if you love the stock at $200, and I know on X, I saw people buying the stock 150 plus saying that it was going to 300. If you loved it at 150 plus, you're going to love it at $81 this morning. So just focus on what makes sense. Is it going to be perfect? If you buy it at 80 bucks a share, could it go lower? Sure. Could it go to 50 bucks? Sure. But your risk reward buying, again, if you have a range, something like this, and focus fire your DCAs, it's a hell of a lot easier to buy this circle than try to buy up here because your reward to the upside is very limited. Your risk is extreme. This is an air pocket. If you're buying air pockets consistently, you're going to lose money. I sat on my hands for half of a year. I went to Hawaii last August and didn't basically buy a damn thing in my main for 6 months. It was one of the hardest things I've done. I have one of the longest streaks where I literally didn't touch anything. Anything I did buy, of course, you get cute, like, oh, I'm going to buy some Bluebird bus manufacturer type company to diversify. And I think it's a value play. Well, of course, that didn't work out. And I trimmed it yesterday. I sold it out of it. It wasn't too bad. I think it was like a 12% loss and it was a small position. It wasn't a big deal, but the only thing I was buying is some of those where I was trying to get cute, like think outside the box, like, hey, I'm not going to buy my favorite names because they're overvalued. I'm going to buy some of these others that I think are value plays, and a lot of times they end up being value traps. But for the most part, I didn't buy anything, and I ended up actually trimming and going to like $300,000 in cash. Of course, I bought, and with this stock, I bought 95 level was where I first started adding, and I DCA'd up because I had a $68 cost basis in the main. So I bought some at 95, 90, and I just, buy those ranges. Yeah, it's 81. Yeah, I could go lower. We weren't pricing in a bear market and recession just 2 months ago, and now we are. So the CapEx risk in the earnings are a risk. Stock can go lower. I don't think it's just going to V-shape from $80 anytime soon unless you have some crazy announcement. And I do like this stock long term. I think in a bear market, you could see 60s, maybe even lower. AppLovin. This is one that we just added recently, a new position in the community portfolio. Woulda, coulda, shoulda, wish I would have added a little bit more, but it did briefly get under $200. Our cost basis is like 205. It's already 240. This is one that's rocket fuel, wants to go higher. It wants to be a market leader. Could it go lower? Sure. The S3 is 161. I would love it. The lower, the better. Anything under 200 in this, I'm going to be buying it unless the story changes. Now you're going to look at it and say, well, is it impacted by tariffs? Maybe not from tariffs, but it could be impacted if we go into recession. Digital advertising generally, though, doesn't have as much downturn in a recession versus print advertising. So with print advertising, if you look at historical data, it's been 20 to 25%. That's for print advertising. Digital is 10 to 15%, depending on the metric you look at. But I also want to remind you that some of that is because during the pandemic, you're going to obviously advertise more digital because everybody's in front of a computer. So I think some of those numbers are skewed a little bit. So you could see something like a 15% downturn in digital ads. So you think of mobile advertising for this with the trade desks, you're thinking more, a lot of it's going to be CTVs is the exciting area that I'm focused on with trade desks. AppLovin is trying, if you look at the investor share letter, they're trying to tap more into the connected TV advertising. So advertising on, platforms, digital streaming platforms. So mobile has kind of been its thing. I really think that Unity dropped the ball and missed an opportunity. Unity did an acquisition that was supposed to be kind of what AppLovin became. And this AppLovin, man, it's, you got to be careful with it. It's a very high risk reward, hyper flyer type, hyper growth name. This thing was just $9, all of a sudden $40, all of a sudden, boom, 525, 10X type of a stock. But this is a significant drawdown, and people are like, that are kind of having FOMO, including myself. Hey, this is an opportunity now that it's come from 525 to 199. And the fundamentals are there. This has an 88 rule of 40, which is one of the highest. Palantir and AppLovin are two of the highest when you look at rule of 40 numbers. Profitability is really strong. It has, a lot of what it's going to be doing is some of this recurring type revenue. So it's going to have software type margins. 43%, 20%. Of course, this can go down, especially in recession. You're going to probably have an impact to some of those digital ads. And it is going to have a premium, but it's a very aggressive growth. This is a hyper growth type name. Price to sales are going to be like 16. But man, if it continues this pace, it's going to grow on that valuation quickly. The risk is that it doesn't continue that pace or competition comes in and disrupts it or something. And this could be one of those stories that gives you a 10X and then fades away. And you've seen a lot of those over the years. Right now, everything points to that this thing, has the ability to be rocket fuel and probably goes back to $500. But don't be completely naive to the fact that, there are a lot of people that own the stock at lower prices and can still profit take from here. But I do think the risk reward is favorable, even in this area here, especially under $200. It's more of a spec play. Tesla. So this was a focus in Fired Up Wealth in 2024, 175. So really in January 24, say, Tesla is something I want to add. And if you look at January, it was, it was sitting in this $200 level, like 175 or less DCA, the preference under 150. I think it can get below 150. And it did briefly get under 150 to 138.60. My cost basis is around $170 or something like that on Tesla. I did sell some. Again, didn't time my trims perfectly at 48, but sold some somewhere up here, 350, 400, somewhere in that level, not 488. I wish I would have done better with that, but it's really hard to time either direction. But I trimmed out. So this was one of my top 10 holdings at one point. I trimmed it back down. My focus area is 200 or less, a preference of 175 or less. So the S3 is 173. You are going to have earnings fairly soon. The last earnings report wasn't all that great. Qualitative wise, this is a strong company. You know, the story's there. $3 to $5 trillion TAM, could be the largest company in the world by market cap in the next decade. Is very possible. Think of robo-taxis, Optimus. At the end of the day, right now, the revenue comes from cars and it doesn't have super high margins, and it's an expensive stock, and it's a retail cult, type stock that we all love, including me. But look at profit margins is 17%. We were just looking at 75% with like an AAPL. Of course, they're very different things. Growth, the growth's not there right now, and hopefully that'll pick up. Right, automotive's been struggling, but you got a forward gap 89, PE ratio, price to sales 6.6. When you look at Tesla versus the other Magnificent Seven names, Google, Nvidia, we're going to talk about next. It's the most expensive one, and it's not even close. If you take Tesla out of the Mag 7, it drops the overall valuation of that Mag 7 significantly. So Tesla is very much the most expensive. It is a $713 billion market cap. Of course, was well over $1 trillion, pushing $2 trillion at close to $500 a share. But last quarter was bad. Fundamentals really aren't in a great position right now. It's really that qualitative story, that retail investor that really believes in the company long term. And I do believe in the company long term, but I don't think it's a $500 stock at this point. And I don't even think it's a $350 stock at this point. Will it be in the future? I think so. And robotaxis, again, and Optimus, huge TAM. I told you earlier, when I think of the largest TAM companies, Tesla's one of those, with the Mercado Libres, with the Amazons, Shopify. Even Uber gets in that conversation. There's a little bit more risk maybe with Uber, but Uber has a huge TAM as well. So I trimmed this recently from the top, holding a smaller position now, being patient, would like to buy at 200 or less. May not happen, but I think there's a good chance it will. Patience. Nvidia. So obviously, I was telling you last year that this is going to be a $150 stock. If you look at the beginning of the year in 2020, around when it was about $7,500, $100 in this range, I was saying this is going to be a $150 stock. This was a pound the table buy in Discord. Really in 2022, 15 or less. YouTube as well, made tons of videos on it, 15 or less. And of course, this had a stock split, but the equivalent of $15 or less. The community is one of the favorites. Most of us have it as a top position. Of course, it dropped down to 87, but now it's back to 100. There's still a chance that you see 165 to 175 later this year. If not this year, I still think it happens in the next 24 or next 12 months. And over the next, year and a half, you could easily see $200 on the stock. Of course, the narrative to that can be broken if, Microsoft and Google and Meta come out and say, we're going to cut CapEx in Amazon. If they cut CapEx, Nvidia is going to sell off. But if you look at the valuation, and of course, this is based on the fact that Nvidia continues to do well, which there will be a cycle to this, right? The gross profit margins are hovering, 70 to 75%. Part of the reason it sold off after the last earnings, I think the market's forward looking and saw some other cracks, but also because of that margin starting to compress, you lose that pricing power. You say, uh-oh, this is going to be a problem. Growth has been off the charts for years with Nvidia. It's just crushing it. But that forward gap PE ratio is 22. Now, this goes back to 2018. If you look at the valuation, so you're getting this stock back. Actually, 2022, I think, is the number. So you're getting this stock at 2022 equivalent valuations. Now, of course, again, this is a forward. If revenue falls, now that 22 can become a 25. It can become a 30. But has the demand for Blackwell slowed down? So far, not. If CapEx starts to get cut, if you go into recession, Microsoft recently told us, if the GDP contracts, if GDP numbers are bad, we will cut CapEx on data center. So if you have a recession, you are going to get a cut in CapEx spend from companies like Microsoft, and Nvidia stock will have more volatility. I think at some point you're going to get through all that, and people are still going to spend money on data center. The whole DeepSeek thing, I think, was overdone, and I still believe Nvidia has a bright future. I think for me, when it gets to 175 and that level, I start trimming again. Everything I have is house shares, has been long since you know the story, 394. And by the time it gets to probably $200 a share, something like that, I'll be mostly trimmed out of Nvidia. Um, I'll still own some, but I'm 13% weight, and I'm going to cut that down, under 5% when we start seeing those prices. Take two is the last one. So take two, you're paying a premium for the new Grand Theft Auto, of course. It found buyers around 188. The 200-day SMA is 175. So this is one that's held up a lot better than other names. I mean, look at this thing. It was 220 and it's only dropped to 200. This is nothing like some of these other charts we've looked at, especially if you think of how bad this stock performed for so long. Look at this stock for a second. Take two, over the last 5 years, it's up 64%. And a lot of that's just recently, but it didn't do much for a long time, right? And even a max chart, of course, 4,000, but that goes all the way back to 97 when no one even knew it existed. It's funny because in 2001, I actually worked for Visual Concepts, never bought the stock, and I've kicked myself ever since then. I literally, 2003 actually was the date. So Road to the Rose Bowl, I did the motion capture talent for football game. Visual Concepts was bought by Take-Two, and I'm not sure exactly the year it was, but this was a $24 stock at the time I worked for Visual Concepts. Now it's 196. I did own it for a while, sold it in 2022 to raise cash for something else. And of course, again, dead people outperform, because if you just would have held it, now it's, it's double from there. So, all right. That is, did I miss any, guys? I think that's all 20. So I appreciate you guys watching. I think the main takeaway here is, if you're a long-term investor, be patient, be disciplined, still have some cash, buy prices that are attractive, focus fire on specific stocks, understand the market has lots of risk, can go lower, but don't stress out, don't panic sell. That's the worst thing you can do at this point. Be patient, have a long-term mindset, do as much as you can to make as much money as you can, save as much money as you can, and invest as much money as you can, because wealth is created in it's created in bear markets. You just don't realize it's the next bull run. This is the best opportunity to buy that you've had in a long, long time. So if you're a new investor, you should be very excited about accumulating shares, especially if you've got a 10-year, 20-year time horizon. This is a great buying opportunity. Can the prices get better? Yes. But just 2 months ago, people were chasing all-time highs. Now many stocks are down 30, 40, 50%. Much better opportunity for long-term investors to get in and to accumulate shares. Thanks for watching, guys. Have a great rest of your day. Take care.